Good morning, everyone, and welcome to the CreditSights podcast, SEC Shifting to Semi-Annual Reporting Requirements, Legal Mechanics, Covenant Considerations, and Market Implications. My name is Mark Lightner. I'm the head of Special Situations Legal Research here at CreditSights, and I have the privilege of hosting today's podcast and webinar. As many of you probably know by this point, President Trump and the Securities and Exchange Commission have signaled support for a shift from quarterly Form 10Q reporting to semi-annual reporting. Today's webinar will explore the legal and regulatory mechanics of doing so, how debt covenants and bonds and loans might be implicated by such a change, and we're going to look at the macro and micro implications of that, and specifically at the high yield market and what that means for investors and issuers generally. A couple housekeeping items up front. Today's webinar is being recorded and will be available on YouTube. And this webinar will serve as this week's episode on No More Risk Better, the CreditSights flagship podcast, which will be available wherever you listen to or watch our podcasts. Let me start by introducing today's panel, which we're very excited to have here. First, I'd like to introduce Jorge Tenreiro. Jorge is a securities litigation partner at the law firm of Bernstein, Litowitz, Berger, and Grossman. Before joining the New York office of that firm, Jorge served in several leadership and high-profile roles at the Securities and Exchange Commission, including serving as chief litigation counsel over the entire SEC and enforcement counsel to the chair of the SEC, Gary Gensler. Next, from the CreditSights family, we have Winnie Cisar, who is our global head of strategy. She is joined by Davis Hebert, who is our co-head of high yield research and head of telecom, media, and technology here at CreditSights. Winnie and Davis are joined by two of our friends at Covenant Review. If you don't know what Covenant Review, it's the leading market expert on bond and loan covenants. It's a Fitch Solutions company that sits under the CreditSights umbrella. We have Scott Josefsberg, who is the head of U.S. High Yield Research, and we have Kevin Grondahl, who is a senior covenant analyst at Covenant Review. So I am joined by these five wonderful panelists. But before we get into talking today, I want to spend just a few minutes setting the table to give everyone a little bit of context in the background of how we got to where we are today. So the Form 10Q requirement came into effect by the SEC in 1970. But in the 15 years preceding 1970, from 1955 to 1970, U.S. issuers generally were only required to report semi-annually. However, there was permissive reporting that allowed companies to issue earnings releases on a quarterly basis, but doing so often triggered reporting requirements under Form 8K. So even before Form 10Q went into effect, the SEC has stated that approximately 70% of companies or U.S. issuers produce quarterly results voluntarily, which clearly reflects a market demand for more information. Now, fast forward 50 years from 1970, under Trump 1.0, the Securities and Exchange Commission requested public comment on quarterly earnings releases and reports, including the idea for semi-annual reporting. But as many of you likely know, that effort did not lead to any rulemaking. So in September 2025, just last month, an organization called the Long-Term Stock Exchange announced that it would petition the Securities Exchange Commission for semi-annual reporting. And a few weeks ago, Trump indicated he supported such a move. And shortly thereafter, the Securities and Exchange Commission, Paul Atkins, said he supported the move and that the SEC would promptly consider the move. So we're going to talk to our panel of experts and discuss various issues. Jorge is going to talk about the legal and enforcement mechanics of such a rule change. Scott and Kevin are going to talk about some of the covenant issues, and Winnie and Davis are going to talk about the market impacts of doing so. But before we dive in, I'd like to poll the group to ask, how likely do we think it is that the SEC is to adopt a rule allowing for semi-annual reporting within the next 12 to 18 months? If everyone could take a second and submit your responses, that would be really great. So we'll give it, folks, just one more second or two, and then we will talk to Jorge. So here are the results. So we say, interesting, very likely 11%, somewhat likely 22.2%, about 15% of the group says it's 50-50, and nearly half of the group says it's either unlikely or very unlikely. So those are very interesting market dynamics here. So I'd like to send this over to Jorge and ask him a bunch of questions because he's our securities expert today. And so, Jorge, could you help explain for the group what is the process for actually making this rule change, for changing this rule that's been in effect for 55 plus years?
Yes, thanks, Mark, and thanks everyone. So it's complicated. The process for sort of rulemaking and rule changes is relatively speaking complicated. There's all sorts of requirements under the Administrative Procedure Act, and I think something that's overlaying the complication here is, well, there's a government shutdown, and it's not. I can't imagine that the staff that would be assigned to work on this is essential. Even without a shutdown, the SEC, and we'll talk about this more a little later, I'm sure, but the SEC is certainly smaller just today than it was 10 months ago, as much as 20% smaller, so fewer people. And then there's also a pretty ambitious regulatory agenda by Chair Atkins. So those are the challenges, and maybe perhaps what's animating the 46% unlikely. I tend to think it's likely because at the end of the day, this is not going to be the most complicated of the rules that the staff is going to have to deal with. The way that it works is there's a couple of options available to the commission for sort of getting this done, right? One is they could just go directly to a proposed rule with a notice and comment period and then a final rule. But sometimes they use something that's called a concept release, which is essentially something that they publish to obtain public input. It's in advance of making decisions about these things, about possible rulemaking. The concept releases typically outline a general topic of concern, identify potential approaches, and then raise a series of questions that the commission and its staff would like the public to specifically address in their submissions. And then the commission has some level of latitude in how much time it gives people. Typically, it gives people 90 days. In groups that are interested might hire a lawyer, might hire a law firm, or an advocacy group, and write some comment letter to them and say, well, we really want you to think about the consequences of this. Or don't forget that if you amend this rule, there's an interplay with this other rule, right? So the commission seeks input from these sort of different market participants. You mentioned that in Trump 1.0, there was something in 2018. I think that was called a request for comment. It's kind of the same thing. It may be simpler. Request for comment, we want to change a rule. Concept release might be for something that's much more complicated or more that's newer, right? This is a relatively simple rule. So what's at issue primarily are two rules under the Exchange Act, the Securities Exchange Act of 1934. Rules 13A13 and Rule 15D13 govern sort of quarterly reporting by certain companies, those that have classes of securities registered, essentially under the 34 Act. Those are essentially exchange traded securities, essentially, your public companies, right? So if you're one of those, you're subject to quarterly reporting in addition to your annual report. If you're if you have another class of securities, such as those registered under the 33 Act, you might also be subject to quarterly reporting under the 34 Act. Some of it depends on, when when you were registered, how long ago, and how many people hold your securities. In any event, even though these are relatively straightforward edits, it can take actually a couple of years. The last time actually that these rules were substantively amended was perhaps not coincidentally in 2008 when Chair Atkins was then Commissioner Atkins at the SEC in 2008. And they were amended to expand the amount of sort of small businesses that were subject to streamlined quarterly disclosures. And that concept came about in 2005, and it wasn't until January of 2008 that it was finalized, right? So if you take an extreme example, it took the Gensler SEC almost the entire term to finalize the rule on climate emissions disclosures, right? Because there can be a process where perhaps the commission requests comment or concept release, and they forgot there's something that they hadn't considered, and some of the comments really make them think. And so so right now the staff is working right on a concept release or maybe even a proposed rule. And after that, the division of corporation finance staff is working on it. Other divisions have to look at it. The commissioners and their staff look at it, and then there's a vote on the either a proposed rule or the final. That's sort of at a very high level.
Well, it seems like one of the things to me, at least, as an outside observer of this administration, is that speed is key, right? And the administration has, they've been in office for 9 months approximately, and they have, pushed through an agenda that, a president in 4 years would be pleased with. And so, speed is really kind of the name of the game here. So, you said it, you think it's likely that this rule may in fact go through. What sort of levers does Atkins and the 3-1, conservative majority on the SEC have to really jam this thing through quickly?
Yeah, exactly. That's why I think it's likely. And by the way, it'll be 3-0 soon because Commissioner Crenshaw's term expires under law the first week of January, and there's been no indication whatsoever that the Trump administration is going to fill Democratic seats of this or any other commission. So the lever, I mean, they have all the levers in the sense that Atkins could just tell the staff, stop working on your crypto rules, work on this rule. I don't know if that's going to happen, or stop working on, your proxy rules and just finish this one real quick, right? Like that's it. He just will tell the staff what to do. So the question, it's interesting because Atkins certainly has publicly sort of aligned himself with the president in a way that I'm not sure other SEC chairs had so openly in the past. And so when he embraced this proposal from the president that came from the tweet that came from the organization that you mentioned, it seems to me to indicate that he's sort of committing publicly to prioritize this. And so that's
Yeah.
why I think it's likely.
No, for sure. That's super interesting. So before we loop in our covenant colleagues, I just want to ask you one question, and this harkens back to, I'm obviously not a securities lawyer, I'm a lawyer, but I did, have a little bit of knowledge of securities, and I grew up in the aftermath of Enron and the like, and some of the legislation that came out there, the Sarbanes-Oxley Act and the like, in terms of officers and directors or officers have to certify certain kinds of filings and the like. And so, if for example, in your view, if we don't have this, the same cadence, what sort of issues, litigation issues, disclosure issues, liability issues are you guys thinking about, just at a high level, to kind of get market participants thinking about, like, how is this actually going to change from a legal perspective on the ground?
Yeah, I mean, I think there's like the practical and the legal. So, from a practical perspective, I think inconsistent disclosures has always been a big issue, and investors don't like that. The markets don't like that. That's always been the sort of the rationale behind Democratic SECs expanding items that need to be disclosed. Um, Standardized disclosures in Form 10Qs that are relatively comprehensive and structured make it easier to compare. When that goes away, that's going to create practical issues for sort of investors and analysts. From a legal perspective, obviously you still have anti-fraud obligations, and so the 8K might be doing more work. I don't think it's going to be a defense to say I didn't have to file the full quarterly disclosure if there was some sort of material event going on at your company, particularly if you've spoken on some subject. I was simply saying that, disclosures under 10B, if the rules under 10B will continue to apply. So, people will have to be mindful, right? Just because you don't have like that quarterly disclosure that's due at the end of the quarter. So there's another practical consequence, I think, is that companies might have to sort of reallocate or restructure their internal controls and internal reporting processes and procedures because they're going to have to be less focused on the end of the quarter and more focused on, what do we have to disclose so that we don't get a lawsuit from investors. And obviously, quarterly reports sort of like help cleanse MNPI, and like that's not going to happen, right? So company executives might actually have an incentive to like make disclosures because they want to be able to trade securities. So that's another thing that we'll be looking out for, I think.
Excellent. Thank you, Roy. That's super interesting. Okay, so I'd like to kind of transition a little bit and talk about how this may implicate bond and loan covenants, because notwithstanding what the SEC may say with respect to reporting, issuers or borrowers in the market may have contractually obligated themselves to, obligations that may be inconsistent or supplemental to what the SEC may mandate. So, before we turn to our covenant experts, I'd like to ask the group a second question. So, if semi-annual reporting is adopted, do you expect significant impacts under high yield bond and loan instruments, i.e., reporting covenants, defaults, pricing, etc.? A, major impacts, B, moderate impacts, C, limited impacts, D, no meaningful impacts, or E, sure need more information. If folks could please vote, and then we will talk to our esteemed colleagues at Covenant Review. What's your prediction here, Jorge, that the market thinks about the interplay between SEC requirements and loan covenants?
I'm going to go with
Any
limited
thoughts?
impacts based on how they answered the first poll. I'm going to go with limited impacts, but I'm probably going to be wrong.
Fair
Definitely
enough.
think that I will say I'd be willing to put money on this rule is passing in the next 3 years.
Fair
That
enough.
one I feel confident in.
So I think limited impacts is where I'm headed to. Let's see what the group says. Oh, interesting. 20% says major impacts, moderate 39%, limited 24, and then no meaningful or unsure right around the 15%. So Scott and Kevin, let's turn to you. Super interesting. We've kind of set the table that we may have inconsistencies between covenants and indentures and covenants and loan documentation. And Scott, I should note for the group that you published a really interesting report called "Will Issuers Still Have to Provide Quarterly Reports if the SEC Moves to Semi-Annual Reporting?" That report is available on our website. So thanks, Scott, for putting out that report. Super interesting. So I'm going to turn to you. So why do we primarily care about this? What do we see in high yield indentures these days? And what are you seeing in the market? And what have you heard anything from clients and the like? So if you could kind of set the stage here for it.
Sure. Thanks, Mark. Happy to do it. You're absolutely right that bond indentures and credit agreements have requirements for financial statements that may be independent of what the SEC rules require. And so on the covenant review side, what I and my colleague Kevin Grondahl did was we took a look at a number of reports covenants for high yield bonds and financial statements covenants for leveraged loan credit agreements with the purpose of assessing whether in general companies would have to continue to provide quarterly reporting based on their bond and loan covenants, even if there is an SEC rule change. And what we found on the bond side, perhaps counterintuitively, is that generally speaking, the reports covenants for public companies tend to provide far more flexibility than the reports covenants for private and sponsored issuers. And I say that because what we generally see is, well, if I back up a second, let's say I'm speaking typically generally what we see. When you look at a particular reports covenant, the answer is not always clear and the answer is not always the same for all issuers and borrowers. To determine whether any particular company is going to be required to continue to provide quarterly reporting because of its bonds or loan covenants is going to require document by document analysis to see what those financial information covenants ultimately say. But like I said, typically what we saw is that the reports covenants for public companies provide more flexibility. And the reason for that is that on the high yield side, what we're seeing for public company issuers is that often the reports covenant is tied to SEC rules, to SEC timelines, and gives the issuer flexibility to comply with the SEC rules. For example, a number of high yield reports covenants tend to require quarterly reporting either in a specific time stated in the covenant, or they have language that says something to the effect of, or such longer period permitted pursuant to SEC rules and regulations, so long as the issuer is subject to the SEC reporting requirements. So we think that would be read to mean if 10Q was no longer required, and instead only semi-annual reporting is required, that's such longer period required pursuant to the SEC rules and regulations, so the issuer would be allowed to comply with that time period as required by the SEC rules. Also, many reports covenants for public companies that on their face require quarterly reporting on Form 10Q also provide flexibility for the issuer to report on any successor comparable form. We think that if Form 10Q were to go away and instead there were some new form, call it Form 10H, that would be a successor comparable form, and these issuers would be allowed to comply with the requirements of that form at the time that is required. Also, many of these reports covenants require the quarterly information that would be required on Form 10Q if the company were required to file such form, and again, within the time period specified within the SEC's rules and regulations. So for the most part, what we're seeing for public companies is the report's covenants generally defer to what's required by SEC rules in the time period that the SEC rules require them. So again, this is a generalization, and we would have to look at document by document, issuer by issuer. But generally speaking, we're seeing the high yield reports covenant for public companies typically refer to SEC rules and SEC time periods, which would allow these issuers to comply with their high yield reports covenant just by following whatever the SEC rules are at the time. And now I'm going to throw it over to my colleague, Kevin, who's also looked at the financial statements covenants for leverage loans. So, Kevin, to start with, what do the financial statements covenants for public company borrowers typically say?
So, and again, this is a generalization. Typically, they're still tied to daily periods. So, typically be 90 days for annuals, 45 for quarterlies. Sometimes they have a longer period. We actually ran into this last year where there was a company that didn't file its 10K on time, and it turned out it actually did not create a breach under the credit agreement because they had a 30-day cushion. But you're still seeing, for the most part, and again, it's not always this way, for the most part, you're seeing numbers of days that you have to file. And sometimes you do see the, or such longer period as granted by the SEC. But as you saw in the special report, that doesn't always track. So sometimes it's in the bonds and not in the loans. And so generally we were seeing that. And the other thing is, I would say it's a lot less common in loans to explicitly tie reporting requirements to what's required under Form 10Q. It's mostly just financial statements audited in the case of annual financial statements and unaudited in the case of quarterlies. So it's a lot less common to see it tied directly to Form 10Q for loans.
So that raises an interesting issue. A company that has both bonds and loans is always going to be required to comply with its tightest covenants. If a public company issuer has bonds that say you can comply with whatever the SEC rules are, but its loans say you must provide quarterly information to lenders, this could create quarterly information. They would likely be in possession of non-public information if that information were not given to bondholders or other market participants. Have we heard from any folks how lenders might deal with that? Or perhaps we would have issuers filing quarterly reports on where the quarterly information of Form 8A anyway, just to make sure that nobody had material non-public information.
Yeah, I mean, when you syndicate a term loan, typically there's two groups of lenders. There's public and private lenders. So public lenders get sort of the general information. The private lenders get things like projections. It would be tough, I think, not impossible, but it would be tough to kind of roll that forward into ongoing reporting, just because the loans are trading and you're not always sure who's there. I can tell you that a public company, New Fortress Energy, they have major asset sales, so they're having trouble getting through the review process and putting together full quarterly financial statements. And they did, as you suggested, filed a Form 8K with financial statements that were not, full financial statements that would satisfy 10Q, but in their estimation anyway, they satisfied the requirements under the credit agreement. So that's how they dealt with it in that case.
So that's an interesting example, Kevin, and a good one, I think. My guess, and like I said, I'm guessing here, is in that case, I think that these public company issuers would probably file the information that they thought was material on Form 8K. Otherwise, like we said, lenders would have material non-public information if they have arms or affiliates that are trading the bonds or trading equity. That would cause a big issue. So that's my guess on how that would go. The more interesting question might be, what are the market responses to that? Would borrowers who are required to provide quarterly information start looking for consents? Or is there any appetite among lenders to provide those consents, and how much would those consents cost?
Yeah, I mean, at this point, those are all kind of unanswered questions. I didn't hear any feedback personally from New Fortress Energy's approach on the 8K filing. Whether the market for term loans is pretty clear that you report quarterly, so I'd imagine there'll be some market pushback if someone tried to go to semi-annual reporting. But again, these are all things that
are going to play out over time.
Yeah, that's my guess as well. And if we move from public company issuers to sponsored issuers, I think that perhaps counterintuitively, public company reports covenants provide more flexibility than sponsored company reports covenants do. And in high yield bonds, what we generally see in the reports covenants for sponsored issuers looks a lot like the financial statements covenant that Kevin was talking about in leverage loans. They typically don't make mention of SEC rules. They simply require quarterly information in 60 days or 75 days after the end of the quarter. And there's no mention of SEC rules there. There's often not even a mention of Form 10Q or such longer period that the SEC rules would require. So it seems pretty clear that quarterly financial information would still be required under a reports covenant that looks like that. And again, just like Kevin and I were saying, it raises the same issue of, are these sponsored issuers going to start looking for consents? Is there any appetite for that? How much are the consents going to cost? And then going forward, in terms of new issues, are sponsors going to propose to report only semi-annually? And will there be market pushback to that? Is there any appetite to allow for that kind of flexibility?
Yes, Scott and Kevin, before we switch to our colleagues on the market front, one final question for you two. In anticipation of a potential rule, right? This is still in the early stages here. It's only been about a month or so. Are you hearing or seeing anything, and or what could you expect market participants to demand in their documents until such a rule is either finalized or shot down?
I don't think we've heard much yet. I think that for the most part, quarterly reporting is the expectation, as Kevin mentioned on the loan side. These seem to me to be all questions that are to be determined.
Yeah, I would agree on the loan side. I would note that you sometimes do see the for such longer period as required by the SEC, even in sponsor deals. Sometimes you see it, but that it's typically only in very aggressive deals, and that had kind of been making its way into documents before this announcement. So the extent to which any of this on the very aggressive sponsor side, I think it's more just they saw a goodie and everybody's taking it.
I appreciate hearing from both of you. Thank you very much. And we may circle back to you in a few minutes. But before we do that, I'd like to transition to our friends over on the CreditSights side of the house and talk about how this impacts us in the markets. But before we do that, we have another poll question for the group, which is, how do you anticipate the credit markets will react to semi-annual reporting if it's adopted? And we say A, noticeable but manageable adjustment period, mild intermittent volatility, limited impact, mostly idiosyncratic, essentially no change at all, or E, too early to tell, will require empirical observation over time. If you could give us your responses, that would be great. And I should also note that if you have questions, please feel free to drop them in the Q&A box below, and we will either do our best to answer them throughout the remainder of today's webinar, or we will circle back to you after the webinar ends today. So we'll wait just another second or two to get some more responses, and then we will look to our good friends Winnie and Davis over on the fundamental research side. So let's see here. We'll give it just one more second. We're getting quite a number of responses. And let's go ahead and see what people have to say. So the majority say noticeable but manageable adjustment period. Mild intermittent volatility is 22.6%. Limited impact is 20%. And then a very small number of folks say essentially no change whatsoever. And then about a fifth of the folks said it's too early to tell and will require empirical observation over time, which is another way of saying it's too early to tell. So why don't we go ahead and switch to Winnie and Davis over on the fundamental research side. So Winnie and Davis, let's look at it from a macro perspective in terms of investor behavior, market structure, valuation, and so on. And so Winnie, near and dear to our hearts here at CreditSights, how might less frequent mandated reporting affect sell-side and independent coverage and research like CreditSights? And more importantly, how is this going to impact market risk from a macro perspective?
Sure, Mark, this is a great question. And I think that we have to keep in mind just already how wide and varied the credit markets are in terms of broad dissemination of financial disclosure and reporting requirements. We've already seen a pretty significant shift towards privatization of credit markets. We all know that we're in the golden age of private credit. Those headlines have been all over the place. And then we've also seen, growth in the broadly syndicated loan market, which has its own type of disclosure requirements. And 144A for life issuance has also really ticked up in both investment grade and high yield. And all of those things have really defined credit markets over the past 10 years. We've seen with this some issues around opacity and questions around market health. This is especially true of private credit. We had Jamie Dimon yesterday talking about more cockroaches coming out within the world of the credit markets. And I think that that's an issue that a lot of people have been very attuned to, and probably, seeing some of the potential changes in SEC reporting requirements is increasing some of the concerns around just the lack of transparency, the inability to really understand what is going on in the market in aggregate in terms of a credit cycle, default cycle, all of those things. From a sell side or CreditSights coverage perspective, I think that it's going to really depend on what the new requirements look like, and then, of course, the adoption of those requirements. There's always the question of alternative data sources. Can analysts derive sector-specific data and trends from private sources of reporting? We have our colleagues at Bixby, which are focused on the broadly syndicated loan market, both on the private and public side of things. And so we can look at their data and understand the differences between things like leverage and interest coverage at fully private issuers versus public issuers. And then I think there would be kind of a shift in sell-side coverage in a lot of ways, looking at thematic reports, cross-issuer reports that really are focused on trying to infer fundamentals across a peer set. But it really does make identifying some of those idiosyncrasies, I think, a little bit different. I think finally, it also will very much increase the importance of relationships with management teams and with sponsors. That's already very important in the LevFin markets. When I was on the sell side and we would be bringing a new deal to market, the top question from sales was always, tell me about the management team. Do they have a proven track record? How confident do we feel in them? But I think that could become even more pervasive in a lot of situations.
And Winnie, you probably see this more than me, of course, but certain countries in the EU and the UK have semi-annual reporting requirements, and many issuers and borrowers do this voluntarily on a quarterly basis. What would you expect from a macro perspective in terms of which kinds of companies may take advantage of this, which ones wouldn't? Would it matter if you go down the credit spectrum that companies would be more likely or less likely to do that, or are IG companies more likely to not report as much? How are we thinking about these issues, and what are we hearing?
Yeah, so I think that it's all about kind of the cost of capital versus the cost of complying with regulation or with kind of voluntary disclosure. And I think within the investment grade world, in the larger public issuers, within the high yield world, I would expect that people would be more focused on ensuring that they have really strong access to capital. Now, there is this question around the growth of private credit and the willingness of private credit to be deploying capital in the investment grade market. Is that, another reason that perhaps issuers decide that they don't actually need to do the quarterly updates? Or within those private credit agreements, will we continue to have a requirement for quarterly updates? So I would expect in general that, the smaller the issue or the more kind of closely held the securities, those are going to be the ones that are already kind of generally 144A for life and not really on the public trajectory anyway. Those are probably the ones where quarterly updates make less sense from a cost of capital and access to market perspective, but may continue to be required just from a bondholder covenant perspective. And then when I think about, kind of the status quo currently is quarterly filings, I would be a little bit surprised if we saw this, significant shift away from quarterly filings to semi-annuals by large liquid issuers, because I think that they would be worried just about access to capital and things like that. And then if we introduce, more heightened requirements around 8Ks and things like that, is it necessarily a significant gain from a financial perspective? Moving away from quarterly filings and then being more beholden to, the 8Ks.
Yeah, and I think you raise a really interesting question, and this is the justification, at least trumpeted by the administration, part of the pun, which is that the administrative burden of doing quarterly reporting seems to be the driving factor behind this. And you raise the conundrum, which is you have to balance the risk of, on the one hand, the savings from quarterly reporting, which for a large issuer is probably not that expensive relative to the overall business, versus the increased potential cost of capital that you may have to pay for being perceived potentially as a riskier borrower or issuer. So, Davis, I'd like to turn to you if you don't mind. Are you seeing these issues potentially play out, or how would you see them play out in the high yield space, or even frankly in the TMT space and some of the credits that you cover?
Sure, thanks, Mark. And Winnie already touched on a lot of this. And I actually don't have a lot of insight into terms of how much it costs to report quarterly versus semi-annually. I think you alluded that it perhaps is a relatively small percentage of the cost base. If you already have staff doing semi-annual reports, I don't know that you can adjust your staffing levels that much or your accounting lift that much. So I think the cost savings on that side are probably not that material. The cost of capital difference is a great point. If you're only reporting semi-annually, I think if I'm a CFO, I think one of my main jobs is to minimize my cost of capital. If I feel like that it's costing me in the marketplace to only report semi-annually, and I have control over that, I'm probably going to be issuing quarterly anyway. And it's not something the CFO, only he or she would have that insight. They're likely going to be getting feedback from buy-side investors who own exposure and saying, "Hey, look, this is costing you by not keeping the market informed of fundamental trends and your operating execution." There's going to be a push from investors to fix that, that gap in reporting. So I think Scott mentioned this earlier, like what does the market really want, right? I think the market's probably going to dictate more around the reporting cadence than someone in DC.
Yeah, it seems to go to, the notion that, we're just trying to give borrowers and issuers flexibility, right? As opposed to mandating it. And the market, as so often is the case in so many things that this administration has done, has dictated a lot of particular policies. And one thing that's so interesting to me when I was, looking at some materials in preparation for today's webinar, is that in the period before quarterly reporting was mandated, so in the late 50s and throughout the 60s, 70% of issuers already did quarterly reporting anyway. So the vast majority did this before it was in fact mandated. But do either Winnie or Davis, do you have any thoughts on how this might impact spreads specifically for companies that choose, in fact, to go from quarterly to a semi-annually reporting cadence?
Oh yeah, I can take a stab at that. I don't know that it's just based on reporting cadence. I think ultimately fundamentals are going to drive spread performance. Generally speaking, like if I have a steady Eddie billboard company that has pretty visible earnings, do I care as much about if they report semi-annually versus quarterly? Maybe a little bit if the macro picture is a little bit choppy. But ultimately, I think it's fundamentals are going to drive spread performance by and large. I think the one thing that I would point to as being particularly impactful for spreads would be the volatility. So if you have fewer earnings related catalysts during the year, you're going to have a lot more volatility. You're going to have much more likelihood of a big surprise, whether it's a big beat or a big miss, right? So you're going to see a lot more turbulence, I think, if an issuer is reporting on a lesser cadence. You can also, if you look at like the control of the narrative, I think one benefit that issuers have in quarterly reporting is they can control the narrative. Investors can try and take control of the narrative and push an agenda or push a thesis. And usually management teams will come in with their quarterly report and say, this is why, this is bupkis, or like, the investors are wrong, or maybe they're right. Management teams can control that narrative. I think if you reduce that cadence of reporting, you open the door for, fast money to sort of push a thesis, push shorts. Maybe you get hugely crowded longs like we're seeing in AI right now. And so the investors control the narrative, and that's not always a great thing for volatility.
You raise an interesting question on that, which is, do you think that management teams, they would never say this, but they hide behind the requirement to do 10Qs as potentially a way to communicate with investors, and in the absence of that, to your point that it creates volatility, why are they coming out and saying this now? What's the point? Reading, between the lines, et cetera. So, do you think that is, that it's a benefit? In other words, management teams view the quarterly process as just another means to communicate with investors.
I think so. I think the quarterly report, I think, allows people to hit the reset button and reset expectations, right? And sometimes those expectations meet consensus, and there's really nothing to do. But in a lot of cases, it can, if a bearish narrative is getting out of control, management can kind of reset expectations that maybe aren't reflected. So I do think the quarterly aspect is a benefit to them in reducing volatility. Absolutely.
Yeah, I do. I want to follow on there. I think that Davis is spot on. If you have a disclosure event that is either quarterly or, off the quarterly cadence, I think that you're going to see potential for larger gaps if, you have fewer of those disclosure events. If you have more frequent disclosure events, because actually the regulatory kind of hurdle changes a little bit from this quarterly reporting of financials to having a different threshold for what is material, what needs to be reported, or issuers are just more proactive, then maybe that actually reverses volatility and kind of takes it down a little bit. I think we also have to think about market structure in general and some of the changes there. One of the big evolutions in corporate credit markets is that sell-side banks tend to hold less inventory than they did before the great financial crisis, especially. And I would say in an environment where we have less access to information, that could perhaps reduce the motivation for sell-side traders to hold inventory or be short. So because you have this risk in either direction. And so that kind of changes the dynamic in terms of a market liquidity perspective. Now, I think the counterpoint to that concern is that we are entering the era of portfolio trading for corporate credit markets. So does that kind of lack of inventory or lack of motivation to hold inventory matter as much when you have more electronic trading, when you have more portfolio trading? I think that is kind of yet to be seen. But in times of stress, I think, of course, it's going to be a bigger issue, especially if we have issuers that haven't reported financials in the past 5 months, and all of a sudden we have some sort of sector-specific blow up. I think that the kind of dynamic for investors might be to sell first and ask questions later. But of course, if there's a higher liquidity or illiquidity premium, that could be a little bit more challenging overall. And then just finally on market structure and liquidity, we have also seen tremendous growth in ETFs. And a lot of ETFs have rules that rely on reported metrics like leverage. So, how do ETFs work in this era of, less financial disclosure? Does that result in, less accurate rebalancings? Does it amplify some mispricings? Does it amplify flow-driven moves? There's a lot of technical market considerations, I think, that come into the equation.
So it sounds almost like, Winnie, to that point, any kind of rule change is not, while immediate, the rule itself may become effective. Market behavior in terms of changes or adoption or compliance with the tighter or the more lax, semi-annually reporting may take a long time, right? This isn't going to be an overnight change. Do you expect the market to have plenty of time to adjust to this as opposed to being kind of a knee-jerk reaction? Is it just setting a runway for a more permissive environment over the long term, or is this something that we should be concerned about today?
I mean, I think that we always need to be concerned about these things, but it's always kind of a slowly melting iceberg, right? These things take a while to actually be kind of fully put into place. And we know that the credit markets are evolving as well. So, if we have a kind of phased in period for the rule in general, as Jorge is reminding us in the speaker chat here, and then you have the market trying to figure out how do we react to this rule, management teams figuring out like what is our best tactic. I don't think it's kind of an all one fell swoop thing. When I responded to this audience poll question, I think kind of a limited impact, mostly idiosyncratic, may make the most sense in terms of how the credit markets are going to react. And that idiosyncratic reaction is going to be to management teams who, maybe buck whatever the broader trend of market adoption is in general. And, valuations in corporate credit markets, they're really complex. They're not just based on fundamentals, they're based on a whole host of other factors as well. So I think this is a really important conversation. It's a really important topic, but I also don't want to put too much weight on it in the near term when it's really complicated and will definitely take time to play out.
Excellent. That's great. So maybe one final question for the entire group as we are winding down here on this really, I personally think very interesting discussion. So if we go to semi-annual reporting, so I want to talk about the immediate reporting norms. Like if there's an event that happens in between the semi-annual reporting periods, I'd be really curious what the thoughts, what everyone's thoughts are. If the markets advocate for a timely 8K style update regime, what do you think some of the best practices might be that could emerge from avoiding selective disclosure? Jorge, since you're the legal expert, I don't know if I want to put you on the spot too much, but I don't know if you want to take a stab at giving your 2 cents on any best practices if we were to go to a semi-annual reporting regime.
I mean, I think, yeah, I mean, I'm definitely not a compliance expert, but like we're looking at those compliance departments and those 10b5-1 plans is something people are going to want to do because it's not, again, what I said earlier, it's not going to be a defense to any claim that like, well, the SEC said I didn't have to report every quarter. Like there's all the other reporting obligations that the securities laws impose that will continue to be intact.
Excellent. And from our covenant review friends, do you have any thoughts in terms of any rules of the roads from a covenant perspective in terms of selective disclosure? If this isn't implicated at all, that's perfectly fine too. Scott or Kevin?
Yeah, from a covenant perspective, usually you do see not necessarily an 8K requirement, but something very akin to that to report any material events. I think that we would continue to see that. And if we were to shift to semi-annual reporting, I would not be surprised if we saw some kind of beefing up of the style material reports to creditors.
Kevin, do you have any final parting thoughts on that issue?
Yeah, I would agree for the most part. I would say that a lot of times in loans, particularly private loans, but also in public loans, a lot of times the reporting requirements for material events are actually MAE qualified, and you could drive a truck through that. I agree with Scott that you might see people pushing back and requiring a little bit more teeth in that covenant.
Excellent. Winnie, do you have any thoughts on best practices or what you would like to see even for selective disclosure in a world where we have semi-annual reporting?
Well, I mean, I think we could talk about this for another hour, but as Jorge pointed out earlier, markets like consistency, they don't like inconsistency. And so I think when we, come to it, like this becomes a question of, does this type of disclosure just become more expensive than simply having quarterly reviews is kind of my top question, because the list of things that might need to be disclosed, be it financial, be it strategic, M&A, big contracts, operational things, capital markets things. It's a pretty long laundry list in general, and I would want to see consistency across issuers in terms of the threshold for what needs to be reported, how quickly it needs to be reported. So I think that there's definitely a lot to unpack there.
No, I totally agree with you. And Davis, final words from you on this?
Yeah, I agree with Winnie. I think consistency is really important. I mean, I think if you put aside the K's and Q's and look at press releases that that offer sometimes incremental information, press releases also sometimes don't offer as much information as a 10Q. So I think for companies that are a little bit, you know, offer less disclosure in their press releases, their interim updates, you'd like to see maybe a little bit more beefier disclosures, but I think that's part of the figuring out period. But I think consistency would be pretty important. I mean, as a high yield guy, cash is king. So I definitely want to see KPIs, revenue, EBITDA, and cash flows, especially to understand how the liquidity for these companies looks.
Excellent. Thank you, Davis. Well, that wraps up our webinar. I want to say thank you to all of our panelists, Jorge, Winnie, Davis, Scott, and Kevin. It's been, I think, a very engaging webinar. Just to remind everyone that this will be available for replay to the extent that you or your colleagues would like to watch this again. It will be on YouTube in a couple of days. And again, my name is Mark Lightner, and I'd like to thank everyone for joining today's webinar. This is a CreditSights webinar. Have a good day.